Hey guys, Toby Mathis here, and today we're going to go over the big tax law changes for 2023. Now, there was this thing called the Secure Act that passed right at the end of the year, and I'll touch on some of those points. But the big stuff everybody really pays attention to is this creeping of brackets, and with inflation being so high, we saw some really high increases in things like the standard deduction and tax brackets in general because they're indexed for inflation. So let me just give you an example. So for example, if you're a single person, and I'm just going to read off some stats here. In 2021, $12,550 was your exemption. You didn't have to pay tax. So for example, if you're a business owner and you're paying your kids, maybe maybe you have a sole proprietorship or a partnership and you're paying your kids to do things like sweep the floors of some of your rentals or whatnot. Whatever the case, you don't have to do any withholding. They don't even have to file a tax return. So you could be paying your kids up to that amount. So $12,550 in 2021. That number is now in 2023, $13,850. $13,850. You don't have to file a tax return if you're underneath that. So that comes into play. That's the standard deduction. If you're married filing jointly, it went from $25,100 in 2021. Last year it was $25,900. So when we're filing our 2022 taxes, it's $25,900. But get this, it is now for 2023 jumped up to $27,700. You do not pay tax on the first $27,700 you make if you're married filing jointly. It's just really extraordinarily high, like as what it's jumped up. I mean, because Tax Cut and Jobs Act bumped them up, and now we're just seeing them. Wow, they've gone up a lot since that thing passed. And of course, married filing separately has gone up as well, and head of household, but what are we at? Married filing jointly, again, $25,100 in 2021, $25,900 in 2022, $27,700 in 2023. Oof. Married filing jointly. Again, you can make a lot of money without having to pay tax. But let's talk about the tax bracket. So we saw some thresholds, and I'm just going to pick a few because you can go Google 2022 versus 2023 tax brackets and look at some of this stuff yourself if you really wanted to get granular. But what I look at is kind of like the big areas. You see the big jump between 24 and 32%. Otherwise it goes 10, 12, 22, 24. So if your bracket jumps from the 22% to the 24%, you don't really feel it. It jumps from 24 to 32, you feel that, right? So for 2022, if you were over single and you made over $89,075, you jumped into the 32%. And so for the next close to, what would that be, about $80,000 up to 170 grand, $170,050, you were in that 24, and then you jumped to the 32% once you got over 170,000. So like realistically, that means that if you're making less than 170 grand taxable income, you're probably not in huge tax pain. You get up over 170,000, you're in those higher brackets. Anything over 30%, I think, is crazy. Really, you're shooting for an aggregate tax bracket of 20% or less is really what you're trying to do, so as not to experience massive pain. You get up to where you're paying, like for example, you're in the 37% tax bracket if you're single and you're making over $539,900 in 2022. That's painful. Or if you're married filing jointly, that same bracket, the 37% bracket, you're in the highest bracket when you're at $647,850. Like, ouch. But those jumped up for 2023. I'll just go from the top down. If you are married filing jointly and you were in the highest brackets at $647,850, you are now in the highest bracket only if you make over $693,750. So it went from 647 to 693, you know, almost a $50,000 increase, whatever that is, 40 some thousand. For single, you were in the top bracket if you made over 539,900. Now it's 578,100. So basically from 540 to 580. Like, again, you're talking close to it, a $40,000 increase in the amount before you're in the highest bracket. So what does that mean for people? It means that you're going to pay less tax in 2023. You're getting some benefit because inflation, you've been getting beat on by inflation. And so tax brackets have gone down. So again, here's an example. You're in the 32% only if you make over 182,100 if you're single, which used to be 170,000, right? So now you don't hit that 32% until you're over 182,000. For married filing jointly, that number went from 340 to 364. So, you know, you're seeing, again, these nice increases in the bracket, meaning that you're paying at 24% a lot more of your income. Like, you can make a lot more money and stay in that 24%. Again, I kind of look at it selfishly. I'm always like, just keep people below 200,000 is kind of my mental factor. Is like, hey, you're in a lot of pain when you're over 200,000. So even in 2023, you're single and you're making 200 grand. Your standard deduction will knock that down a little bit, and you're staying below the 32% bracket. You're staying in the 20s. That's usually a win. And remember, brackets is for each amount that you rack it up. It's not retroactive, so it's not like it's 32% on all of your income. It's only 32% on the amount over 182 if you're single, or 364 if you're married. So that's why it's so critically important to keep yourself in those 20s, because aggregate tax bracket, you're going to be below 20%. And that's what we look at. Now, what else does inflation adjust? So for 2023, the big ones are things like your IRA contributions. You can now go from $6,000 to $6,500, which is a nice chunk of an increase. It's not, it's not stellar. It's not quite 10%, but it's still a pretty good size. When you're contributing to your 401k, what do we have? 403bs. You can put in now the employee side, the deferral that you can immediately just push right in there. It went from $20,500 to $22,500 for 2023. So for 2023, you as the employee can now defer immediately $22,500. And you have a much bigger catch up. So if you're over 50, so you got some gray hairs, you get an extra $7,500. So when you look at that, it's 30 grand that you could put into your 401k deferred. First 50 or 30 grand that you make. And that's per spouse, per year. That's a big chunk of money that you can put away. The IRA is a little different. Obviously, the contribution limits are $6,500, but you do have a catch up there as well. If you're over 50, it's $1,000. So if you're over 50, or if you're 50 or older, to be more specific, you can put $7,500 a year into your Roth IRA or Roth, or your just traditional IRA. Not a lot of juice. That's why we go to the 401ks and defined benefit plans if you really want to jack it up. Big changes if you're a real estate investor or if you're a business owner is this thing called bonus depreciation, which is 168K of the code. And we knew it was going to be dropping to 80% in 2023. We've known since 2017 that was going to happen unless Congress took action. They didn't. So bonus depreciation goes from 100% in 2022 down to 80% in 2023. Some things to think about, though, is because sometimes you have the ability to do bonus depreciation, or you could just 179 it. And people didn't always do the 179 because there's some funky little rules for 179. You can't create a loss, and if you get rid of it, there's recapture. If you sell the property, there's some recapture, but you can use 179 and bonus depreciation on the exact same property, or equipment. So just know that that's probably going to start factoring in if you're working with a tax professional and you have a lot of equipment or a lot of purchases you're doing through your business, or if you're trying to do a cost seg on a property and you're bonus depreciating and you have other businesses, they might start having a discussion with you about there might be other options for writing some things off, depending on the circumstances. So again, bonus depreciation can create losses. It is now 80%, and it's scheduled to go down 20% a year until it's gone. And it can create a loss. 179 can't. Speaking of 179, it is capped this year at 1,160,000, and there is a phase out. I think the phase out, gosh, what is it? 2.8 or something. It's a really high phase out that you got to wear. Nobody's had to pay much attention to it over the last few years, other than maybe if you're in a state that doesn't recognize bonus depreciation, you're still using 179. Otherwise, most people are using bonus depreciation. So again, for real estate investors that do cost segs, just be aware that your bonus depreciation is going to be 100%. So if you have 5, 7, 15-year property and it's worth $200,000, last year you could take $200,000 loss. This year, now it's going to be $160,000. You don't lose the 40. It's still 5, 7, 15-year property. It's just being depreciated over its useful life. So you don't lose anything. It's just you're not getting as much of it's called bonus depreciation for a reason. You're not getting as much of the bonus in 2023, starting in 2023. Things where they increased it, though. Let's talk about that. So how about your solar energy credit? They've done some weird stuff there, and it's going to be worth digging into depending on where you're located in the country. But the solar tax credit for putting in energy efficient, or not energy efficient, but clean energy. So putting solar up on your rentals, for example, things like that, is 30% tax credit. You take half that tax credit, subtract it from the basis, and you can depreciate the rest. And they treat solar property as 5-year property, which is really, really generous. So, you put a $50,000 solar unit on there, you're going to get a $15,000 immediate tax credit, not a deduction, tax credit. And using those numbers, you'd get half of that as a deduction against the installation too. So 15,000, you'd get half. So you 7,500. So let's just figure math in our head. That means that you'd have 42,500 that you could immediately depreciate. You could 80% bonus that, and then 5-year the rest. So it's, in other words, you're getting tax credit and massive deduction. But it even gets better. They did this weird thing where they said if you source the materials domestically, you can get an extra 10% of tax credit. And if it's being used for low income, so if you're putting this on your rental properties, and it's 80% of the state median income, so it's low income, you get an extra 10% tax credit. So you can get up to a 50% tax credit on putting solar. So we're going to have to explore that a lot in greater detail, because, for a long time, people are kind of looking at it going, I'm worried about what happens to the equipment. I kind of want to watch what's going on. But here they're basically saying, we're going to give you a credit for half of that. Cuts the price in half. And all of a sudden you have your own energy source. So if you're doing low income and you're able to source everything domestically, which I don't know how hard it is. I know that there's the 30% tax credit, or $7,500 tax credit for electric vehicles. That's going to be almost impossible to meet, because they have half of that is a local source requirement for all the minerals, like the copper and things like that they're putting in the batteries, lithium, and all these things, right? There's a question as to whether any manufacturer would qualify for the full credit. And as of right now, I think the answer is no. And then I think it has to be made domestically too. So that's going to be a weird one. So stay tuned. We'll definitely be talking about those, but those popped up. And then there's also a deduction and a tax credit that's available for energy efficiency. The big one is, I think it's 45L, where you have a tax credit that can go up to $5,000 per home. For single families and manufactured homes, I think it's 2,500, but it actually goes up to 5,000 for all of them. You get a tax credit if you make it zero energy, like if it's energy neutral. But if you're going, I think it's making it more efficient by, I want to say, drop down to 25%. You're able to get a much larger credit, and under 179D, which is a deduction, you could get a much larger deduction. I think it went from 188 a foot to $5 a foot. So you have two things. You have 179D and 45L. 179D is really only for big multifamily. I think it's 4 stories and above and things like that. 45L is for anybody who is building or doing complete remodels and making your units more energy efficient. You might be looking at a tax credit on the 45L. My friend Eric Oliver talks about it sometimes. I might get him on to do something special just in that area so we can dig into it. What you need to know is if you're a rehabber or you're one of those people that's building, be aware, talk to your professional about whether or not you qualify for the 45L tax credit, because it can be up to $5,000 per unit. So again, you have these people that are doing huge remodels on apartment buildings, gutting them, take them down to the studs. You're probably going to qualify if you make it energy efficient, and that's a nice little bit of chunk of change if you get a tax credit. It's not a deduction; it's dollars in your pockets. Goes right towards your tax liability. All right, at the beginning, I mentioned the Secure Act 2.0, which just passed at the end of 2022. It's effective now. What it did is it increased the required minimum distribution age. Doesn't help you at all if you've already hit your RMD. If you turn 72 in 2022, sorry, this doesn't help you. But for everybody after that, it's 73 right now. It goes up to 75 in 2033. So it just means that your required minimum distribution age got pushed out to 73. So now you don't have to take RMDs. It's 73 in 2023. So if you turn 72 in 2023, you don't have to take it. So if you turn 72 in 2022, you do, right? So but for some of you guys that were expecting, you knew that you were turning 72 in 2023, you already scheduled your distributions. You may want to go revisit that. The other thing is, if you don't take your RMD, it used to be this 50% penalty. Now it can go down to 10% if corrected. The immediate decrease is it went from 50% to 25%, but that 25% can be reduced further to 10% of the required minimum distribution. So like they used to take a chunk if you didn't take your RMD. Now you can say, hey, if I take it and I fix it, it's 10%, which seems less draconian, makes more sense. Starting in 2024, so this is way out ahead, RMDs aren't even going to be required for Roth accounts at employer retirement plans. I don't think you have RMDs on IRAs, but there's still, if you had it in a 401k and you didn't roll it, then technically you might have gotten hit with a required minimum distribution tax-free out of a Roth. That would be annoying, but it's not like it penalizes you, but I think that goes away in 2024. And then keep on the lookout. I don't know too much about the savings account that they're going to have. It's basically a Roth account as a savings account that can be in defined contribution plans. So 401ks, they'll probably have the ability to put an emergency fund aside, kind of like a Roth for your employees. So that might come out. They're trying to make it easier to put emergency funds aside for people, since they probably aren't doing it themselves. So maybe the employer can just say, hey, push it aside for you. I don't think it's coming out of the employer pocket, though. I think that you actually have to elect it, but it is kind of your money being pushed aside for your benefit by a third party, which to me is just, I never really understand that stuff. I get it why they're doing it, but we shouldn't have to. Required qualified charitable distributions. This is something that we use when you have RMDs that are required and you don't want the money to make your other income more taxable, or you're a giver and you want to just go to charity. You don't want to use your percentage, the 60% limitation for cash or 30% for property or appreciated assets when you're making contributions to charity. If you don't want to use that up, your AGI limitations, you can give immediately up to $100,000 for a married couple of qualified charitable distributions directly out of your IRA. And then this year, starting in 2023, people who are 70 and a half or older have this weird little thing where they're allowing you to do a one-time gift to a charitable gift annuity, a unit trust, a charitable remainder annuity trust. It's kind of these. It's a one-time up to $50,000 gift. So I guess if you're married, I think it's up to $100,000. But you can do it to this. Again, it's kind of odd. A charitable remainder trust or to something else. So you're getting the non-taxable income. So the reason that you do a qualified charitable distribution is so it's not income to you. And you're not, it's just basically offsetting. So I'm trying to figure out how they're going to make it work with the charitable remainder trust. I have to dig into it because usually you have a limitation on how much you actually take as a deduction, but it might be that they let you treat the whole amount, which would be very interesting. I'd have to dig into that a little deeper. So again, stay tuned. We'll see how that might be used to the benefit of somebody who's sitting there saying, hey, you know what, I'd rather have a revenue stream. I don't need the money right now, but I want to make sure that I have income for the rest of my life. A charitable remainder trust might be interesting. So I get it, why they're doing it. The gift annuity and the annuity trust, I have to get my head around that one. Last thing is the 529 plan. And again, some of these are, I'm just giving you what's changed. It's 2023, so there's not a lot of mental energy that's been extended on them yet, but just be aware. But they're talking about after 15 years, 529 plans can roll into a Roth IRA for the beneficiary. So for those of you guys who have been doing things for like your grandkids or planning to do things for your kids or your grandkids in a 529 plan as part of that working for their education, and then you're worried, well, what happens if they don't use it? It looks like after a period of years, 15 years from what I understand under the Secure Act, you could roll that into a Roth IRA for them. So the money could be there for their benefit. You didn't take a deduction for it, so nobody took a deduction, and they're not going to tax you on the increases. I think there might be a lifetime limitation of like 35,000, but you're able to move some of those monies over, which was always kind of a what do we do with it? If we don't use it for the education, what do we do with it? Right. So they've been trying to address that for years. Me personally, not a huge fan of the 529 plan, but I know a lot of you guys use them. So it's worth, mentioning. So the big ones, if you're a real estate investor, obviously the big one that everybody's paying attention to is the bonus depreciation. Decreasing, going from 100 to 80 isn't life changing, but it's something to watch because next year it goes down to 60%. And it would really be great if we kept it at 100. That was a huge incentive in the real estate market for investors. As the economy continues to shift, depending on what the Fed does. I mean, I think we're all dependent on the Fed right now as to what's going on. They seem to be pivoting and slowing down interest rate increases. And then they've stated that they're going to stop those increases in 2023. But we don't know what the future holds. Real estate obviously has been getting the brunt of the negative attention from the increased interest rates. Even though mortgages are tied to the 10-year treasury, it causes things to get wonky and cause those rates to go way up. They've come down a little bit. We'll see where we're at. Obviously, whenever you listen to this, you can go look. But it'll just be interesting since they're affecting, that little thing affects the real estate world, especially on the investor side. That little bit of bonus depreciation may not affect you horrifically in 2023, but I think it's compound effect in 2024 if it goes down to 60%. Then when it goes down to 40%, it's going to have a negative impact on investors. And we are at least 3.5 million to 5 million units underbuilt in this country, and we're seeing building slow down because they raised interest rates and affordability is a factor, and it's really tough. So just watch those things because a lot of times Congress takes action by giving incentives and posing that carrot. So we're going to watch that bonus depreciation carefully, but everything else is really inflation based. And we knew inflation was really bad, and we knew that the tax rates were going to, or the tax brackets were going to get adjusted and go up. And I think everybody's kind of pleasantly surprised that it seems to be consistent with inflation, and that you are going to get some tax relief. So 2023 is going to be a good year for those of you guys who are having been seeing some of your money being pushed into those higher brackets, and maybe it'll stay in some of the lower brackets now. We'll see. All right. I hope this was helpful for you. If you can, like and subscribe. It helps us. And share this with anybody who you think would benefit from this information. Thanks.